How George Soros stole billions from England. Experts in international finance will never forget September 1992. In particular, George Soros, chairman of the famed quantum family of funds, Soros and the investors in his four pools based in the Netherlands Antilles made a cool $1.5 billion in a single month due to the upheaval in European markets. Furthermore, it is not the Soros Group's only investment this year. His flagship quantum fund, which has $3.3 billion in assets, saw a 31% increase in net asset value between the end of August and the beginning of October, and a 51% increase so far this year. His AUM had climbed to $7 billion by the middle of October. Hello everyone and welcome to another video on our channel. In today's video, we're going to discuss how George Soros stole billions from England, so stay tuned to find out. Now let's start our video. Other significant beneficiaries emerged from the currency turmoil that knocked down the pound, the lira, and other soft European currencies and embarrassed Europe's central banks. Among the many affluent individuals who have benefited are Bruce Kovner of Caxton Corp. and Paul Tudor Jones of Jones Investments. Kovner's funds increased in value by around $300 million to $1.6 billion. Jones' fund increased by approximately $250 million to $1.4 billion. Citicorp, JP Morgan, Chemical Banking, Bankers Trust, Chase Manhattan, First Chicago, and Bank America benefited from the turbulent month of trading that knocked the European exchange rate mechanism down. Because of currency trading, they made roughly $800 million more than typical in the third quarter before taxes. The European exchange rate mechanism was formed in 1979 by the members of the European Economic Community to maintain a relatively stable exchange rate among the various European currencies. 11 European countries were assigned trading ranges that were rather narrow and well-defined. However, if countries' economic strategies were to be coordinated, the system might be viable. If, for example, inflation in one country was considerably higher than in another, the system would be severely stressed. Another element that could put pressure on the system is the gap in interest rates. When the discrepancies in interest rates and inflation rates among the 11 got too big, central banks were forced to intervene and buy the sinking currency to safeguard it from speculators and currency hedgers. Historically, powerful central banks were able to thwart speculation. They accomplished this by flooding the market with the stronger currency following huge purchases of the weaker currency. The tide, though, is changing. In contrast to the tens of billions of dollars central banks can move, daily trading volume on the foreign currency market has surpassed $1 trillion. When the market flooded the banks, Soros and the others who benefited constantly did one thing: they shorted the weakest currencies. There are several methods for shorting a currency. The simplest way is to take out a loan in one currency, say the Italian lire, and exchange that loan for another, say German marks, at the market rates. Then you wait until the lira falls dramatically against the DM, at which point you buy in the now cheaper lira to service your loan and end up with many extra douche marks. If you're liking this content so far, please consider subscribing and liking the video. Now let's continue. In September, the lira exchange rate was 765 lire to the market. After 4 weeks, 980 lire were needed to acquire a single DM. Any speculator who attempted this maneuver would have pocketed 28% of the money they needed to borrow. However, he would have profited far more than 28%. Speculators with large credit lines, such as Soros, have access to 5% margin loans with 20-to-1 leverage. As a result, with only $50 million in collateral, you can borrow $1 billion for speculative purposes. In other words, rather than making 28% on your lira wager, you would have earned $280 million, or 560%. George Soros is notoriously private and has remained so despite his recent success. Nevertheless, he had already determined that the European central banks were playing with inferior cards compared to the speculators and hedge funds. As a result, he was willing to put everything on the line. Britain and Italy failed to make their currencies competitive, keeping interest rates high to entice investment. This limited their possibilities for boosting their economies. Germany tried to curb its overstimulated economy, while Britain and Italy suffered from weak economies. When it became clear that the Bank of England couldn't prop up the pound, banks began selling it short with their own money. In September, risky financial firms made $200 million in pre-tax trading gains. It could have been much higher. These benefits won't be fully felt until the third quarter. Banks roll over trading earnings to the next quarter to reduce their tax liability. Soros and his associates sold short $7 billion in sterling, $6 billion in the mark, and a smaller amount in the franc. While shorting the sterling, they bought up $500 million in British stocks, gambling on their growth. Soros bought German and French bonds while dumping shares. Soros believed the rising market value was bad for equities, but excellent for bonds because it lowered interest rates. Well, that's all for today's video. Tell us in the comment section how this one was. I hope that you found this video interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.